We've got good news today. The Ceridian UCLA Pulse of Commerce Index is up 2.5% in the month of March. That's in a single month, up 2.5%. That more than offsets the losses that we had in January and February. The story of our index is that we were in pretty clearly a recovery mode until the middle of last year, until last summer in 2010, when we started kind of stumbling along, and the index has not been powering forward. Now we're powering again. We're having some very significant growth in March. Hopefully it'll continue. On a quarter-over-quarter basis, because of the weak January and February, this first quarter is up 3.9% compared to the quarter previously.
We're still forecasting GDP growth, however, near the lower end of the range of estimates that were in place for the first quarter as of last month, which were between 2 and 5.5% at that time. So we remain consistent in our forecast of around 3% for the quarter. One of the really bright spots remains the year-over-year performance in the index. It was up on a year-over-year basis by 3.6%, which is the 16th straight month of year-over-year growth. It leads us to conclude that we've obviously emerged from the recession. The economic recovery is still underway, but it's not yet what we call robust. There's still not enough growth to drive meaningful gains in employment. As a side note, the absolute growth number of 3.6% is encouraging, particularly because the index was up against a very strong comparison in last year's month. Last year, the index was up about 7% on a year-over-year basis, and to grow over that number was a nice surprise.
Another interesting fact about this month is that the gains were concentrated in the regions that were weakest last month. So the South Atlantic region had a huge negative last month, and it has an even larger positive. There's a very strong negative correlation between performance last month and performance this month. That's symptomatic of a problem with the winter weather and with the snowstorms. And March, to some extent, is particularly strong because it captures some of the sales that might have otherwise occurred in February when the winter was rather harsh, and we actually had a Category 3 snowstorm in the beginning of February.
We've shown that the PCI has shown a remarkable correlation with the government's industrial production report, and February was no exception. We forecast a flattish number of minus 0.02% for February, and when the Feds issued their initial estimate for the month, it came in almost right on that number at 0.0%. For March, we expect industrial production to show relatively strong growth of 0.08% when it's reported on April 15th. As of now, the PCI indicates that the spike in fuel prices haven't yet had an adverse impact on the economy. Our index provides a leading and amplified view of what's coming, so if fuel starts to impact the economy, we should be one of the first indications of that.